Hi, I'm Ed Parcaut, your host of Inner Edison. What I'd like you to take away from today's episode is our greatest accomplishments come from our greatest defeats. And I also bring on guests who can help you not go through some of those great defeats, possibly. And today's guest is Jonathan Feniak. Did I get that right?
Feniak.
Feniak. I was trying not to, I didn't know I had to emphasize the knack so much. Feniak. Anyway, I'm Ed Parcaut. So let's talk about your story, kind of how you got into this. And then we were talking off air about LLCs and what your companies do. I'd like to really get into that because people always have that question. Should I do a corporation or should I do a LLC? Should I do an S Corp or should I do a C Corp? Mm-hmm. So, right. So let's quick how you got into it. And then we'll get right into the nuts and bolts.
So I started out in transportation logistics, worked with a lot of guys from the military, as you are, and thank you for your service. Really appreciate that. I was in New York City on September 11th, and was under tremendous pressure at that point in my life. Decided came out of it okay, but sort of reevaluated what was going on in my life and went and got an MBA. And became a financial professional, worked at hedge funds, worked with high net worth individuals. And time again, I saw individuals who had built up vast sums of wealth, and then something happened, whether it was the financial crisis of 2008 or 2000 or something like 9/11 or a divorce or a lawsuit or something else that wind up really stopping their plans in their tracks. And that always concerned me, and I thought there was really not enough focus from in being a financial advisor on those downside events. We call them credit events that happen that really can have a significant impact on your life going forward. And I decided I was going to go to law school. So this was not too long ago. Being a lawyer is actually my third career, but I've worked with high net worth individuals and trusts and estate planning and entity formation and all the things that I'm doing now for a very long time, assisting my clients doing it sort of on the other side of the table. And coming into the practice of law, I wanted to focus on asset protection and privacy. I think privacy is something that all of us deserve. It's a constitutional right. We have a constitutional right to privacy, and everywhere along the way, people are trying to deny us that. I also think we have a not constitutional, but state-based right to asset protection. And limited liability companies are one of the easiest ways that you can protect yourself from those downside events.
Right. And one of the issues in my state, California, I own a mortgage company, and basically Department of Real Estate and the NMLS license, you can't have an LLC. Right. But under the DOC, you can. So it's like, it's a pain because I'm old school. I've been doing it so long, and that's how my license is. I have to change everything over to go to LLC, but I'm also looking at that. And that's why when I saw that you were on my guest list of somebody to get on the show, I definitely wanted you on the show.
Yeah. And that happens frequently. And I think what you need to do is think about, well, what needs to be licensed? What is the licensure part of my business? And the licensure part of your business is going and selling real estate. Are there other
loans? Actually,
loans. I'm sorry, loans.
That's right. Okay.
It's going and selling mortgage loans. Are there other parts of the business that potentially be split off into entities which are not regulated? So if you have it happens. An easier example is you have an operating business that owns a building. And so you've got your operating business, which is serving the public, okay, that works within a building that's owned by that company. Well, owning a building is a totally separate business than operating a company.
Right.
And so what I advise my clients to do is you have really two businesses. One is being a landlord. Oh, it happens your tenant is your business, but that doesn't change the fact those are two businesses. And so effectively what you can do is end up with an operating business that has a significant amount of liability, but has little in the way of assets because it works with sister companies to own those assets. Another situation is I work with a lot of trucking companies, people in the transportation business and logistics, and those folks, you've got big rigs worth $100,000+, and you may have 10 of them. Okay, owning a truck is not really a risky business. What's risky is operating it on the road. And so in those cases, we set up the trucking business, which interacts with the public and drives trucks on the road. And then there's a vehicle leasing business, which leases vehicles to its sister company. And in that way, if there's a lawsuit, it's not going to be from, well, it might be from poor maintenance of the vehicle, but in most cases, it's going to be through negligence of the driver that had nothing to do with the operation of the vehicle. And so for folks who are in highly litigious businesses, that's one of the recommendations we often make. Split your business into its constituent parts so that if there's something related to the operating entity or liability related to the operating entity, it doesn't blow up the whole thing. You could walk away from that and, in your lending business, oh, well, we got sued, but I've still got a $5 million commercial real estate portfolio here, right? Or I got my trucking business and we had a terrible accident, but I've still got $1 million fleet or multi-million dollar fleet of trucks that I can start up a new operating entity and begin that cycle again. Start up the operating business, have the asset-rich businesses protected and off to the side.
That's really smart. I mean, because a lot of people, I know a lot of people who do their business under a Schedule C still, right? And I tell them, you need to go get
insanity.
You need to go get, because first of all, you're not protected. And second of all, those are exactly what the IRS looks for to audit, because you don't have attorneys, you don't have people protect you, don't have a CPA, you don't have those people doing it. You're doing it underneath that way. And they know that you don't have those things to fight them. And that's not to get the IRS to come after me, of course. That's historically what I'm told by accountants.
No, so there's different kinds of creditors that we run into our lives. And if you promise Wells Fargo, you're going to pay them back, pay them back. Like they're going to come after you with, every ounce of their legal team. If you have if you owe money to the IRS or Department of Justice or the state, they're probably going to get it. What we're talking about is situations where there was there's a slip and fall or an accident. One of your employees did something, those judgment creditors are going to look at you and say, how much are you worth? That's how hard they're going to fight. If they see that, well, this business has a $5 million commercial real estate portfolio, they're going to fight that much harder. If they see that this business, it doesn't have much, right? It has some tools in the back and what's in the operating account, they're not going to fight that hard. And a win in those cases is that you had a good liability policy. We recommend you always start with a liability policy. And the liability policy will have a certain limit, what you can afford, what you think is a good number. And there's not going to be a reason for them to argue for an amount more than that liability policy. If you can get to that point, that's an absolute win. That happens often with folks who are in real estate, where we help them set up the real estate owning entities, and then they have a management company. The management company deals with the tenants, it's in charge of maintenance and all of these other things. It has its own policy, as well as you've got a landlord policy for the building owning entity. And in the event that there's a lawsuit, they're most likely going to sue both, but a court will apportion that liability to both and say, well, part of it was negligent maintenance, part of it was just a defect in the building. It's sort of a premises liability that's hard to shed. But you will have had two insurance carriers, two policies, two legal teams fighting, and it's going to allow you on the other side of those entities to come out hopefully unscathed. Your checking account, your savings account, all of those other assets you've built up are going to be protected from the claims of those judgment creditors.
Yeah, because that's what people don't realize when you're when you're a Schedule C on your tax return, every asset you have is going to be liable to be taken from you because you have no protection. Right.
Yeah, and in many states, and California is one of them, but most states are this way, especially for a sole proprietor, not a sole proprietorship, a single member LLC. You're not that much better off than you are just as but you're a little bit better off than you would be if you were just a sole proprietorship, if you were a Schedule C filer, because states courts don't give single member LLCs the same respect they do to multi-member LLCs and even husband and wife LLCs. I'm reluctant in most states to just have a single member LLC. Sometimes you don't want partners. I understand that. You don't have a spouse. You can't bring in someone else as another member in your LLC. But what you can do in that case is build in another layer of protection with a Wyoming LLC as a holding company for your state-based LLC. As an example, There are 8 or 9. Most states are in this same group. When it comes to veil piercing, are you familiar with veil piercing?
I am, but I'm sure my
Right.
listeners are not.
So veil piercing is when a plaintiff or a judgment creditor attempts to say that this LLC should not be respected. It should not actually limit the liability of the members. They should be allowed to pierce the veil of the entity and get to the individual, get on the other side of the entity and get to your personal assets. Most states, there's a litany of different elements that a plaintiff can rely on to get to you as an individual. Did you commingle funds, right? So are you buying groceries out of the entity accounts? Are you paying expenses of the entity, which is sometimes more common, that people don't have a clear dividing line between themselves and the entity? Are you observing entity formalities? Are there meeting minutes? Do you have an operating agreement? Are you actually following them? So there's all these different tests. And in most states, a single member versus a multi-member LLC, a multi-member, you're more likely to have the veil preserved. A single member, you're more likely to pierce. If you have a holding company, if they were able to pierce the veil of your California LLC, they'll only get to a Wyoming LLC. Okay, that's on the other side of the veil of your California entity, not you. And in Wyoming, under Wyoming law, there's very few reasons that someone would be able to, or elements that someone can use to pierce the veil. Single or member, specific statutorily, does not matter. A judge may not consider that. And so you get down to a very small group. One is, did you engage in fraud? And hopefully not. If you did, well, I'm sorry, you're sort of screwed, but you probably deserve it. Be honest in your business dealings. And then did you commingle funds, right? So the commingling funds is the most important thing not to do. But other than that, according to Wyoming law, they should not be able to get to you. They got into Wyoming, but what'd they get? Not much.
And so what you mean by commingling funds is the Wyoming paid for something of the other LLC or vice versa, right?
Yeah. If the funds are needed at the California LLC level, well, it should be a contribution, recorded. The sole member, Wyoming LLC, is contributing $10,000 to California LLC to further ongoing operations, not put the money in or pay the expense. Ignoring that entity form is what commingling is going to be. Or there's profits in the California LLC and you just make a distribution from California. No, you're not the owner. Wyoming is the owner and you're the owner of that. And so it's an extra step, but you have a bank account for California. You've got a bank account for Wyoming, and that there's only flows between them properly recorded in the books and records. And I like to imagine I'm in front of a judge and a plaintiff's attorney is trying to establish that these entities are really, it's just one. This is just a scam, Your Honor. And I've got a stack of documents I can give to the judge, put on the table and say, nope, here's the bank accounts, here's the entity filings with the state, here's meeting minutes, here's operating agreements. Your Honor, what else do I need to do to show that this is a real company? The judge is going to, nothing's for sure,
right.
But you got a really good shot of that veil piercing not happening.
All right. So the Wyoming LLC owns the California LLC.
Mm-hmm.
Right? That's what we're talking about. So the holding company basically is holding multiple, and they can hold multiple companies, right? And
can hold dozens. And some of our clients, 60, 70 subsidiaries underneath their Wyoming holding company.
Wow.
And those sister companies, as long as you're treating them as separate companies, you're not sending money back and forth here. You can on a contractual basis in that example with paying rent, but there's a rent agreement or lease agreement and the payments are made. That's just payment for services. They're two separate entities there. But in order to get from here, subsidiary A to subsidiary B, they actually have to prove that both should be pierced up to the top in Wyoming, and then they're merged together and all the assets are commingled or available to the claims of a plaintiff. So it's extremely difficult for them to make that prevail on those claims.
Now, so the LLC in Wyoming, right? So would you ever just have an LLC out in Wyoming in different states? Or is it better to have each state? Because I know there's a foreign statute or something
Mhm.
about a corporation that's part, because I know I've seen that in
Yeah.
California. So how does that work?
So states have rules about what constitutes doing business in their state. And California has one of the broadest interpretations of any state of what constitutes doing business there. And so under California law, if there's an out-of-state LLC, which has a member, an owner who's a citizen of California, that's LLC is treated as doing business in California and has to register as a foreign entity. If you have California also says that if a foreign LLC, let's say it has no California members, it's got, Wyoming members, but it owns more than last check, $66,000 worth of property in California, it needs to register as a foreign LLC in California. Even if it's not engaging in business, it just owns property, mere property ownership is treated as engaging in business in California. So California is really strange. Most states have, and just so we're clear, I'm not licensed in California. Okay, talk to a California attorney, and our clients do, but I deal with enough Wyoming clients who are saying, do I need to register as a foreign entity? And we've talked to outside counsel, our California counsel, and gotten this advice from them. So in most states, though, mere ownership of property or interacting with the citizens of that state is not going to be treated as engaging in business there. So you got an e-commerce business that sells, widgets or sells tablecloths to someone in Ohio. You don't need to register as a foreign entity in Ohio. The line is typically going to be, do you have a brick and mortar business there? That would usually mandate having registering as a foreign entity there. Or do you have employees there? That's also going to be sort of a triggering point for you. We rarely recommend, though, registering an entity as a foreign entity in a particular state. It's much better to instead form a subsidiary in that state. Let that subsidiary then have the employees. Let that subsidiary own the brick and mortar store. And the reason is 2 layers of LLCs is much stronger, especially when you've got, the Alamo of Wyoming, where it's going to be very difficult to get into. I don't know if Alamo's maybe it's not a good the fortress. We'll call it the fortress
because everybody died in Alamo.
I know that's not a good. No, okay, it's not the Alamo. It's a fortress, an impenetrable fortress,
Fort
virtually
Knox.
impenetrable.
Fort
What's
Knox.
that?
Fort Knox.
Fort Knox. You're right. There you go. Thank you. It's the Fort Knox where it's going to be virtually impossible for that plaintiff in Ohio to break through the Ohio LLC and get into Wyoming and actually achieve something there.
Now, is there any reason you would do a corporation in like Delaware or some other state? Because I've heard of tax reasons you do your corporation there. But then if you still have to come to California and register as a foreign corporation or doing business, would that negate that tax benefit?
So corporations are different. So if you have a Wyoming corporation, A lot of folks will set up a Wyoming corporation for this reason. Wyoming corporation, which owns a Wyoming LLC, which then owns an Ohio LLC. Okay. Being a shareholder, a California citizen being a shareholder of a Wyoming corporation, that Wyoming corporation does not need to register as a foreign entity in California. It only applies to LLCs, so partnerships, right?
Okay.
When it comes to corporate taxation, Wyoming has no corporate taxation. So if you have a corporation in Wyoming, if it has, let's say it's everything is within Wyoming that it's doing, it's trading stocks and bonds and things, and it's a Wyoming corporation, all it's going to pay is the federal tax rate. If it has source income from Ohio, you've got a Wyoming corporation which owns an Ohio rental property or an Ohio LLC which has a rental property, the corporation is going to wind up paying Ohio taxation because it has Ohio source income. Okay. The states which are, Delaware is a good state as well to form an entity. And the problem with Delaware is twofold. It's expensive to set up. And then they also have very significant fees associated with the number of shares outstanding you have. Wyoming doesn't have that. It doesn't matter if you have a million or 100 million shares outstanding. They don't charge more for that. Folks will who are interested in doing an outside capital raise, are going to be raising capital from outside investors, sophisticated investors, will often go to Delaware because it makes investors feel more comfortable. They have something called the Court of Chancery that has very stable decision making and has had stable decision making. So it provides certainty to that investor. If you want a corporate form or a corporate tax structure, and you're not going to be bringing in outside investors, it's merely for the benefits of that lower, at least under current law, lower corporate tax rate, Wyoming is a great place because it's a lot cheaper to set up and maintain.
All right. So my question, I keep bringing this up because I know how I'm taxed in California, right? We have a huge state tax. So you were saying how Wyoming wouldn't, if you had a corp, you wouldn't have to register that corp. But if I had it licensed to do the loans, right, and we're doing business in California, I still wouldn't have to register and pay the state tax to California.
So if it's registered in if it is operating a business and engaging in business in California, it would have to register as a foreign entity.
And then still would pay taxes though in California.
You would, it's California source income at that point, and so you'd pay tax based on that. Okay. If you have let's say you have a call center in, I come up with hypotheticals where you wouldn't be subject to California tax, right. But if part of your business is not occurring in California, you've got a management company that's a corporation in Wyoming, and it's working on a 1099 basis with your company in California, the potential is there that it's a consultant. It's doing all of the operations outside of the state of California. You could potentially move that income out of California. Talk to your California tax advisor about this. Yeah. We're setting up these structures all the time for folks who they've got a small piece of their business in California, and the rest of it is being conducted either offshore or in some other state, and they're like, I'm getting taxed on every dollar in California, which doesn't make sense. This is a way to avoid that.
Right. Because that's what, in California, it's by county too, right? If I do this county, or I should say this city wants its mill tax, but if I have half my volumes coming from some other counties or other places and they don't have that, they still want to know it, and they still want to make sure you're paying on it, but they don't have that same tax. So, right. I'm just throwing out different things. This is a 2-3 hour conversation that we're trying to have in 30 minutes. So, but I do have one other question. All right. So so protecting trademarks, right? Should those be done in a separate LLC versus, so like if I own Inner Edison, right? Should that be in an LLC protected as, like, say, Big Hangry Media owns owns Inner Edison the rights, and owns the I have a phrase that I use in the mortgage business called building personal wealth through home ownership, and it's being trademarked. Should that be owned by that other LLC? So if for some reason I decide to close up my mortgage company, but and then open a new one, it's not tied to that company.
That's exactly right, and it's an asset just like a building. Right. So separating out the intellectual property, have an IP holding company in Wyoming, and it licenses that intellectual property to this operating entity in California. And there's a licensing deal. It's a bona fide contract. There's a royalty paid, or there's some compensation paid. It's recorded. And if the operating company in California is sued, there isn't going to be an asset available to that creditor of the name Inner Edison and all the intellectual property and trademarks and other things associated with it. So just like a building, you're separating that off, putting it into another entity so that it's remote from where the liability is.
Now, if you have an LLC in California named a certain name, and then you decide you want to now protect it differently, and can you do the same name in Wyoming if it's available, and then just transfer it all over?
So if there's a transferring the asset from one LLC to another when there isn't a change in ownership. So you wholly own the California entity and you wholly own the Wyoming entity. From the IRS perspective, there isn't a change in ownership. So you're contributing it from taking it out of one LLC and putting it into another. Should not be a taxable event. Depends on the entity type, and there's some other things that may be involved there. But in most cases, you can do a transfer of the asset. I believe tax code 367, transfer that asset between the entities as long as the ultimate ownership is not changing. From the tax perspective, nothing happened.
No, just talking to you, it's like I want to protect some things. That's why I'm asking. Yeah.
Yeah, and doing an analysis of, well, where is your risk? In the lending business, there's regulatory risk as well as people being just unhappy with your business. And one of the questions is can they get to you as an individual for actions you're taking on behalf of your entity? And as a licensed individual in a particular state, there's potentially some liability you can't shed. I think about a doctor. If you're an obstetrician and a mom and baby die on the birthing table, you don't have enough insurance. I don't care how much you have. You have 5 million, 10 million, that those lives are priceless. And so at a certain point, folks will say, well, how can I protect my assets, my personal assets, because I have this business liability I can't get rid of? And that's when we get into the discussion of Wyoming asset protection trusts. And a Wyoming asset protection trust is like you're creating, I use the example, you're creating a rich aunt or a rich uncle, and you tell them, please hold on to this money for me. I'm gifting it to you, okay? And they will hold on to that money. And if you get sued and a court says, uncle or aunt, give that money to this plaintiff, the uncle or aunt will say no. And if you want to try to make me come up to Wyoming to force me in a court of law, you, though, can go to your aunt and uncle and say, I had some unexpected medical bills, aunt or uncle. Can you please give me $50,000? Sure, here you go. It's your money. Boom. It's not your money under the eyes of the law, but it's close enough. Or I need college tuition, or I want to go on a round the world cruise because I just am really stressed out from everything that's been going on in my life. Sure, here you go. And so it becomes this very safe place to keep your money away from your personal liability. Now, those are more complex structures. There's more cost involved in an LLC, but it is that next step up in asset protection when you've gotten to that, $5 million net worth in your personal name, not in your business, and you still are concerned about being sued. And it can happen even with you get in a car accident, and the plaintiff's attorney says, "Man, this lady looks rich, so we're going to go at her with everything we've got. It's going to be, pain and suffering, multiples of it, this and that." And you're looking at, you got $1 million worth of auto liability, and you're looking at a $3 or $5 million claim. In those cases, and I've seen it with celebrities, whether it's Beyonce hitting somebody or whoever else. In those cases, what are you going to be able to do to protect yourself? And if you don't have one of these asset protection trusts, I'm going to argue not a lot, especially those assets that are within the state in which you're going to be suffering that judgment.
And now, because a lot of people put their stuff in trusts, right, for their properties and stuff, does that protect you against any of the stuff like this?
Most trusts do not. So these are self-settled, qualified spendthrift trusts drafted under Wyoming law. A revocable living trust, your estate planning trust, provides no protection. A land trust provides no protection. Okay, those are just estate planning and probate avoidance vehicles. Those are not asset protection vehicles. And many states don't allow self-settled trust. And by self-settled, what I mean is that I'm putting the money in and I'm the beneficiary. You can put money into it. It's for your kids. It's for, somebody else. Your mom puts it in for you. Okay, that's a third party trust. Those are going to be allowed under most state laws or every state law in the country. And those plaintiff or judgment creditors against me will not be able to get to that money because my mom put it in there for me. Okay, somebody sues your kids, they won't be able to get to that money. But this is where I put the money in. Self-settled is not permitted under, I think there's 17 states at last count that allow for self-settled trust. But Wyoming has built an entire industry and built its statutes so that they are both on the LLC side as well as the trust side to be the most protective in the country. And there's an arms race. Nevada and Wyoming are going hand in hand. I guess, there's not a lot of people there in a particular state, then South Dakota has also been working on it as well. But there's this arms race of states saying our laws are the most protective, and it's advanced over the years to where these trusts and these LLCs are damn near bulletproof.
Wow. Now, if you own property in California, excuse me, can you do that thing you were just talking about with the Wyoming trust, and then they allow you to put those in there in protection, or
you're always going to have the problem of a California court ignoring the structure you've established. And so they say, well, yeah, I know there's this Wyoming trust, but they're not allowed under Wyoming law. And there's this property here that we know is yours. So we're just going to give it to the plaintiff. Let Wyoming come down and sue us, and then they've got jurisdiction over them, and they can, argue it there.
Right.
So the better thing to do is, and I know this is uncomfortable to some people, is to what we call equity strip. So effectively cash out, refi the properties, get them to where you have the highest LTV you can get, 80% LTV, and take that 80%, whatever that cash was you got out of it, put that as cash into the trust, right? Because then it's outside the state of California. It's no longer under the jurisdiction of a California court. It's sitting in a brokerage account located up in Wyoming. And by minimizing the assets you have in a state where you're likely to be sued, you're limiting your downside when you have this Wyoming Asset Protection Trust. That can also be beneficial with just having doing the same thing. You got a brokerage account, you've got investment assets, put them into a Wyoming LLC. A Wyoming LLC is going to be, there's something called charging order protection on a Wyoming LLC, where it's going to be difficult if a California court observes Wyoming law, which it should, and you've got an appealable case if they don't. You can say that a creditor, the best they can do is stand on the outside of your Wyoming LLC and wait for a distribution to be made, but they can't break into it and seize those assets. If you've got a California LLC with $100,000 or $1 million sitting in it, and you get a personal judgment against you, a California court will likely allow that plaintiff to break into that LLC and seize those assets. Won't happen in Wyoming.
Even if it's multi-member LLC?
Even if it's multi-member or single member, a California court.
You were saying single member, they don't even care about.
On a multi-member, they still may allow, depending on the nature of the assets, depending on the operating agreement, other things, may allow that plaintiff to seize that membership interest. Good news, you got a new member now. It happens to be, the person I hit with my car. Knock on wood. No one's hitting anyone with their car.
Yeah. Well, I know. I'm just looking at, because we're in the middle of building a house on 32 acres, and it's going to be a big house. I wanted to protect it. So I guess the easiest way to do that is just to move to Wyoming or somewhere
Montana
else.
Or Idaho or something.
But the problem with that is I have to deal with weather then.
Yeah, we're dealing with fires. We're dealing with everything nowadays. What are you going to do?
Yeah. We get hot, but then in the morning it's 67. So,
That's nice.
So.
Colorado sounds like it might be right for you. We're the same thing.
I grew up in Colorado.
Did you?
Yeah. My dad worked for Ma Bell, so we moved from California to Colorado all the time to wherever his next advancement was. So it was Denver, Clifton, Maybell,
awesome.
Grand Junction, everywhere.
I love Colorado.
Yeah. And you can't. A lot of people say I'm moving out of California because of how bad it is with all the politics, and I'm going to Colorado. It's the same.
Well, there's a group here in Colorado, and what they say is, we want you to be able to smoke weed at your gay wedding with your guns on your back. I'm like, all right, that sounds, I'm cool with that.
Yeah. Well, here is a little different, but a little different. I'm in the Central Valley area. We're different than the coastal elites. We're normal people here. We're trying to fight to take our state back, but because the single, I want to say single member now that you're saying, we've been talking about membership, but I'm talking political. One party, single party is not working for me anymore. So yeah,
Colorado's pretty evenly divided. I think it keeps us on an even keel. So.
if somebody wants to get a hold of you, what's the best way to get a hold of you?
WyomingLLCattorney.com. So through our website, you can form your LLCs there. We've tried to make it as easy as possible. One of the great things about Wyoming is your personal information doesn't show up in the Secretary of State website. So no one's going to know you own that LLC unless you tell them, which is absolutely, there's only 3 or 4 states that allow you to do that. But our website will make it easy. And then booking time with attorneys. There's a number of attorneys who are internal or external, specific areas of expertise, and you can book time with us, half an hour chunks, really easy to do. You sign up, you reserve that time, and I'm not allowed to do anything else during that time. I'm there to talk to you. So it is it's really easy to access us, and all we focus on is asset protection and privacy. If you got a DUI or got in a car accident, we're not your guys. But if you're concerned about asset protection and privacy, we're absolutely your guys.
Yeah, it sounds like you guys know your stuff. So, Jonathan, thank you for being on today.
Thank you. Thank you very much.
Excuse me. It's this weather going back from Texas and California and then San Diego from where it's just killing me. Anyway, I want to thank you for joining us here on Inner Edison today. I hope you enjoyed today's episode with Jonathan and listening to all that you needed to know about LLCs, but I'm sure he didn't touch enough on everything for you. So please reach out to them, contact them to get your answers. And again, thank you so much, Jonathan, for being here.
Thank you so much.